Hello folks, happy Friday and welcome to this week's video version of Weekly Commentary. Well, a new week and new concerns for markets and the economy. Since the beginning of the year, it feels like a game of whack-a-mole trying to fend off a moving target of potential threats to the markets and the economy. Beginning February, fears were driven almost entirely by AI concerns. Investors were terrified about the pace of change, AI disruption, and whether some tech firms, even entire industries, would either become obsolete or at the least far less profitable in the future than they have been in the past or was anticipated they would be in the future. Nearly 2 weeks ago, those fears all but disappeared, not because anything had been resolved regarding those AI concerns. Instead, new fears have emerged with the beginning of the war in Iran. Currently, there are fears over escalation, and particularly the closing of the Strait of Hormuz and the resulting impact on oil prices. That's driving volatility in equity and bond markets, and this kind of rapid shift in investor attention is a good reminder how markets typically behave in the short term. Investor sentiment can change quickly. In short term, markets are typically driven by investor sentiment. Fear and heightened uncertainty tend to push the markets lower, while optimism and confidence drives prices higher, at least in the short term. 2 weeks ago, the fears did shift, but it is still fear and uncertainty today that dominates sentiment. For advisors and investors, this does reinforce one of the most important elements of investment decision making, and that is managing emotions. If portfolios are adjusted every time the market's short-term sentiment changes, the result usually is to buy high and sell low. The past several weeks has provided a textbook example of that dynamic. If you look back a couple of weeks ago during those AI-driven fears, assets that have performed worst during that period, notably software companies, Bitcoin, other risk assets, have been among the best performance since war concerns have taken over the narrative. When sentiment changes, typically leadership in the markets change. Investors who reacted to the AI fears a few weeks back by reducing exposure to risk assets are now watching those same assets enjoy somewhat of a rebound, while assets that were performing better then are currently doing poorly since war fears have overtaken AI fears. The war, and particularly the closing of the Strait of Hormuz, highlight an issue that has become increasingly clear for nations over the past several years, and that is the importance of energy independence. Countries that rely heavily on imported energy are much more exposed to geopolitical disruptions. Nations that have strong domestic production are more protected, less vulnerable. From a market perspective, the current relationship between oil prices, equities, and interest rates has been consistent with oil supply concerns of the past. On days when oil prices rise sharply, stocks tend to fall, sometimes precipitously, and interest rates move higher, and vice versa. And the reason is pretty straightforward. Higher oil prices function like a tax on the global economy. Consumers spend more on energy and have less discretionary income, while businesses face higher transportation and production costs. At the same time, higher energy prices contribute to inflation pressures, which then pushes bond yields higher and prices lower because investors are anticipating perhaps even tighter monetary policy. We've seen this dynamic play out before numerous times, more recently when the war in Ukraine began back in 2022. Then oil prices jumped roughly $45 a barrel in a short time. Economists estimated that increase clipped about 0.13% from U.S. GDP growth. And while the growth impact was negligible, the larger issue was inflation. Today, the inflation picture has already been a bit cloudy prior to the war, notably because of tariffs. The good news is Wednesday, the inflation report came in as expected. Headline CPI rose 0.3% month over month and 2.4% year over year. Core CPI increased 0.2% month over month, and likewise registered 2.4% year over year. And today, the Fed's preferred inflation measure, PCE, likewise provided good news on the inflation front, coming in better or as expected across monthly and year over year numbers. All of them look pretty good, and under different circumstances, those numbers would give comfort that inflation was continuing to gradually moderate. Markets likely would have rallied. However, the numbers came in from data that occurred or was collected before the war. And if the war continues much longer, and or if the Strait of Hormuz, through which flows 20% of the world's oil supply, remains closed for weeks or longer, inflation numbers in the coming months will likely look hotter. Hopefully investors look past that as temporary spikes. That then decreases the prospect for rate cuts this coming year, which is another issue that could vex investors. The big question is, how long is this going to take? And there are reasons to believe it may take longer than most would like, at least what we thought just a week ago. And longer than markets may tolerate before breaking. Going this far and not completing the job in Iran would lead to questions such as, what was the point? If the regime stays in place, we will have only bought a few years before Iran rebuilds and resumes being a global threat and powerful sponsor of terror. And perhaps, because of this action, more likely and eager to build nuclear weapons. If the situation stabilizes relatively quickly and energy shipments continue without major disruption, long-term impact likely will be very limited, the economic impact. Oil prices undoubtedly will move lower, inflation pressures would ease, and markets could refocus on underlying economic fundamentals such as growth, earnings, and technological innovation. In longer term, it is those fundamentals that drive markets higher or lower, not short-term sentiment/fears. While the war may last longer than we'd like, it isn't likely, in my view, to negatively affect those longer-term fundamentals to a large degree. And in the short term, we may be able to count on what has been called the Trump put. That phrase was coined during the president's first term, when with a few words and what were then tweets, he had the ability to move markets in an almost uncanny and predictable manner, reliable manner even. That phenomenon continues during his second term, and it's likely that the president will hopefully successfully talk down excessive short-term fears until the job in Iran is complete. For long-term investors, the key lesson from the past several weeks, it's not about predicting the next geopolitical development or next technological disruption. It's about understanding how quickly investors' short-term focus can shift and to remain focused on the long-term fundamentals. 2 weeks ago, investors were worried about AI. Today, they're worried justifiably about war, escalation, rise of oil prices, but who knows? 2 weeks from now, the dominant uncertainty may be something entirely different. The challenge for long-term investors is not identifying every new fear that emerges. It's maintaining discipline despite those shifting narratives. Markets always rotate from one concern to another. Investors who stay focused on long-term fundamentals rather than reacting to each new headline typically are the ones best positioned to navigate whatever the next narrative may be. And looking longer term, even looking toward the balance of this year, today I remain confident fundamentals remain intact. There are two potential significant headwinds facing the economy and markets. One, tariffs, and the other, of course, oil prices and the war. The good news is that these headwinds are not beyond control, not out of control. In fact, controlling them is a matter of one man's decisions. And in the past, the president has shown the flexibility to make different decisions prior to things breaking economically or in the markets, notably in the bond markets. So as always, I'm going to do my best to keep you up to date on what this year has so far shown to be rapidly changing events. In the meantime, I wish you all a wonderful weekend.